Hello, this is Bob Steele. In this video, we will be talking about income tax and types of taxation. Objectives will be define and describe the progressive, proportional, and regressive tax. We want to define and describe marginal and average tax rates. We want to build the tax equation, be able to understand the tax equation. There's two reasons basically behind these objectives, or a few reasons behind these objectives. When we think about tax, we're often thinking of two ideas. One is we're debating whether the tax is fair. Obviously, tax is a law that we have, and the law could change. So we might be debating in terms of what type of tax is out there, what type of tax is fair, what kind of changes might be made to the tax law. And we need to understand these terminologies in order to deal with that question. We also need to, from a practical standpoint, just be able to define how the tax law is currently set up, and therefore plan our taxes accordingly. And if we were in the tax preparers, either for our self-preparing or for a preparer for other individuals, we need to just apply the tax code. So in that case, we're thinking of it in terms of an application versus thinking of it in terms of the fairness and differences in laws that could change. So, the history of the tax, the modern income tax, is based on the 16th Amendment to the Constitution. That didn't happen until 1913, so that's sometime after the beginning of the country, and of course, the country being started with some skepticism about taxes being started in such a way that being taxed without representation is one of the principal ideas behind the revolution in the first place. So obviously people were skeptical of taxes, and the taxes will generally increase when there was a time of war. So obviously the main reason that the central government is there is for foreign affairs and for self-defense. So many of the tax increases that have happened throughout history happened because of results of some kind of foreign event, usually a type of war, that would then of course increase the necessity for income taxes in order to finance that. So that's the original idea of the central government, the original cause for the central government taxation. There are many types of tax structures. Three basic forms of tax structures are the proportional or flat tax, the progressive tax, and the regressive tax. So these taxes, most of the taxes that we have are not going to fall maybe directly into these categories, but these are the three kind of categories. If we were talking about pure taxation in these three kind of ways, we could think about these principles and see where different types of taxes fall into these core principles, these core three types of taxes, and what are going to be the implications of that. So this is going to be important when people start talking about the reasons for taxes. Why are we going to have tax, or what is this tax doing versus that tax? Why is this tax good or this tax bad? And we're going to use these principles in order to define that, and we'll hear these principles when people start talking about taxation. So, proportional or flat tax, I'm going to start off with this one, although this is not, of course, the one that our income tax is on. That would be the tax rate remains the same regardless of the tax base or income. The reason I want to start with this is because this is probably the type of tax that most people would think of. It's the most simplified tax. So when people talk about simplifying the tax code, they're often going to say something like, we need to flatten the tax code. And when that argument comes up, they're really talking about a proportional or flat type of tax. And if you look at it, what the effect of that would be, we would have, say someone had income of $10,000, or income versus $100,000, or income of $200,000, the flat tax would just say, hey, just give us 10% of it. And therefore, the person who gets $10,000 of income would still pay taxes. They pay $1,000. The person who makes $100,000 would pay more tax. They would pay $10,000, and the person who made $200,000, $20,000, and the tax rate, the rate would stay the same, whatever rate we decide. But of course, the amount would go up with income levels because it would be that same rate of a higher income level. So that would most likely be the simplest tax that people would come to mind when a tax comes up. Now, of course, we could come to the idea that if someone only made $10,000 and they had a family of 4 or something like that, then maybe we need a lower tax rate, or maybe we need a zero tax rate at some base. And if someone made a very large amount of income, maybe we want that tax rate to increase. Even though the amount of tax is going up, maybe we want the rate to go up as well, to have a higher increase in the rate. And that, of course, is closer to what we have here on the income tax structure. We have a rate that increases. So the federal income tax uses a progressive tax structure. So tax rates increase as the tax base or income increases. So if we took that same scenario, we got the 10, if someone earned 10,000, maybe they get taxed, and we won't do the calculation on this one because the calculation will get a little bit more complicated, but we'll look at it conceptually, and then we'll start to look at a simplified example, and then we'll get into the more complicated tables that have more tax brackets in them. But if the income was 10,000, maybe we tax them at 10%. If the income goes to 100,000, maybe we tax the first 10,000 at 10%, and then we tax the everything above the 10,000 to the 100,000 at 15%. So now we have two tax brackets. We'll talk about that a bit more later. But if maybe we take the person that has a 200,000 and we tax the first 10,000 at 10, the up to 100,000 at 15, and the up to 200,000 at 20, or something in that fashion, meaning the tax rate goes up as people earn more taxes. This is the type of structure we have, and you can start to see it's a little bit more complicated to talk about someone that has a 200,000 income. How much tax do they pay? We can't just multiply it times a rate. Can't do it because the rate changes. Of course, tables don't have a problem calculating this. Computers don't have a problem calculating this after the fact. But when you're trying to calculate how much tax you will owe, it can be a little bit more confusing to do that. The regressive tax is the tax rate decreases as the tax base or income increases. Now, for income tax purposes, we don't consider a regressive tax. We're not going to set up a tax structure. If we're going to tax based on income, it would be counterintuitive for most people's logic to say, okay, as people's income goes up, their rate's going to go down. So, for example, if they made $10,000, we'll tax them at 20%, and if they make $100,000, we'll tax part of it at a lower rate. For the most part, that doesn't make sense for income tax, for normal income tax purposes. When people apply these same kind of terminologies to other types of taxes, the term can change a bit. So, for example, the sales tax, if you were going to take a tax on consumption, many states that we have a consumption tax, a sales tax. Many countries, other countries would say they're going to have a consumption tax, may not have an income tax at all. Remove the income tax, have a consumption tax. You could think about what the effect of that would be if we tax someone when they go to the store and spend rather when they earn. Then it may create an incentive to save. And so if I don't get taxed till I go to the store, maybe we'll save more of that. So in income tax, on the other hand, which is what we have, we tend to be a spending country, and the income tax versus a sales tax might be part of that cause, some would argue. The consumption tax, some would say it's flat in that it's going to be a flat rate. If we just charge 10% for everything we buy, so if you go to the store and you buy $300 of groceries, you're going to get taxed at 10% of that. If someone had a lot of money and they went and bought a yacht for $1 million, they'd get taxed at 10% of that consumption on the yacht. So in that sense, it's flat in terms of the purchasing, but many people would argue it's not flat in terms of comparison to income, meaning it's actually going to be regressive in terms of comparison to income, because if you made $10,000 and that's all the money you made for like a family of four maybe, then you're going to spend that entire $10,000 on the necessities, food, gas, whatever, and therefore you're going to pay 10% on 100% of the income. Whereas if you made $200,000, you may spend $100,000 on stuff, and be taxed 10% on the 100,000 that we spend, but the other 100,000 would then be saved and would not be taxed. So notice that the tax on income, we would think in that scenario, would go down. It would be regressive in that way. So many people would argue that the sales tax is regressive, meaning it taxes a higher percentage of people's income on the low income side than it does on the high income side. Now, there's a lot of variations you can try to do other than just saying, okay, the sales tax is no good. A lot of people would then argue that, well, what if we take things like food out of the sales tax or gas out of the sales tax, utilities out of the sales tax? Then the necessities are no longer in that taxed area, and we would only tax things that are more on the non-necessity side. So the person that went out and bought the yacht, then of course would be taxed. The person that goes and buys food would not be taxed, and that would be a way to adjust for this. So notice that when you hear the arguments on these types of things, these are the types of things that will be in place. They're going to use these terms, and we got to kind of see how these terms apply. So two types of tax rates to think about. We have the average tax and we have the marginal tax rate. So when we're calculating our tax, we need to kind of keep both of these in mind. They're going to be very different in a lot of cases, and we're going to have to see why they are and how they can help us with our decision making. So the average tax rate. This is the average rate of tax that you pay. So the marginal tax and comparison, this is the tax rate on the last dollar we earn. So let's give an example of this. This will be our highest tax bracket, and the marginal tax rate will be greater than or equal to the average tax rate. So we're going to give a simplified example here and just talk about a two tax rate system, and then calculate this out and see what this means and how it can be applied. So we have we're going to say that the first 250 we earn in a year are tax free. So the first 250 we're not going to be taxed on. Then everything over the 250 is subject to a 50% tax. So that's going to be the rule. The first 250 we earn in a year are tax free. Everything over the 250 are going to be taxed at 50%. Therefore, if we only earn $200, that is less than the 250, and therefore we're not going to be taxed. If we look at that pictorially, we can say our first 250 is not going to be taxed, and then 50% tax on everything above that. So in our case here, we only had the 250, therefore it's not taxed. So we only had the 200, which is less than the 250, and therefore is not taxed. Let's take this scenario and add and say now we're going to earn $300. So remember, our rule is that 250 of that 300 is taxed at the first rate, a progressive tax rate, the first tax rate being 0, and then we only have a 2 tax tier system, the second tax rate being 50%. So now we make $300. So the 250 is free, and the 50% tax rate is applied to everything above the 250. So in our case, we made the 250 of the 300 is tax free. There's not going to be tax on that first piece, but the $50 to make up the $300 will be taxed at 50%. So we're going to take the $50 times 50%, and we're going to owe tax of $25. So we earned $300, we paid tax of $25. And there's two ways we can think about this when we're trying to plan for the future. We're trying to say, well, what should I do in the future in terms of my earning potential, in terms of my spending, how much taxes will we pay? We have two different rates that we can think about. One is the average rate, where we're going to say, well, we took the $25 is what we paid, we earned 300, so 25 divided by 300 means that we paid on average 8.33% tax. Our average tax rate is 8.33%. But if we earn more money, we know that it's going to be taxed at the highest tax rate, at 50%. So our marginal tax rate is the highest tax rate, in this case 50%. So when we start making decisions, we can start thinking, well, if we start earning more money, we have to realize that every dollar is going to be taxed at the marginal tax rate above the $250 threshold. What will that do to these two numbers? As income increases, these two numbers will get closer together. Now let's talk about the tax equation. It looks like this. We have gross income minus deductions for adjusted gross income. So we're going to talk about different types of deductions. Remember, when we talk about the tax equation, we're talking about the income statement. So in some way, we're talking about income and income statement. We're not talking about the balance sheet. So when you think about the type of financial statement, we're going to talk about the income statement. And so we're going to start with gross income. We have a few types of deductions. We have above the line deductions, which are going to be called deductions for adjusted gross income. We'll talk about what falls into those kind of categories for deductions, and that equals the adjusted gross income. So this is a subcategory. And then we're going to subtract the greater of itemized deductions or standard deductions. We'll talk about this in another section. What this means is basically the standard deduction means that everybody's going to get some chunk, some basic deduction that will reduce their income. So that's kind of like us saying that people will not be taxed at a certain portion of their income because they're going to get this lump deduction. The itemized deductions are the ones that most people think of when they hear deductions. Like at the charitable, the medical deductions, the mortgage deductions, those all fall into the itemized deductions. We only get the itemized deductions, however, if they are larger than the standard deduction. Then we have exemptions. Exemptions are kind of like deductions, but we're basically going to give a deduction for just the person. So themselves and dependents count for exemption. So we're just going to assign a dollar amount to the dependents and the individual taxpayers and give exemptions as a form of decrease in the taxable income. That will give us the taxable income. That is basically kind of what we would think about as kind of like net income if we were talking about bookkeeping. That's the end result. That's our taxable income. Then this is kind of deceiving in that we're saying, oh, then we just multiply times the tax rate as if it was a flat tax. But that's not the case. We have to basically look at the table to see what the tax will be because we have a progressive tax system. So then we got to calculate the tax based on a table, basically. And then we might have AMT tax, which is a recalculation of the tax that we won't get into too much at this point. But that's going to be a recalculation of the tax. It's kind of actually flattening the tax scale. We'll talk about that later. That would give us the tax liability. And then, of course, we already have paid much of our taxes at this point. We paid it throughout the year. So we're going to subtract out both credits and payments, and that will give us hopefully a refund or the amount that we owe on the taxes. So types of individual tax forms. Individuals will use one of the following forms based on the complexity of the tax return. It's either going to be a 1040, a 1040A, or a 1040EZ. So, of course, when we think about individual taxes, we think of a 1040, the major form. The tax equation we just looked at will be basically in the 1040, and that's what we're going to be calculating. The 1040A and the 1040EZ, of course, are a basic 1040 that eliminates unnecessary parts of the equation because a taxpayer does not need those parts, so we can just take them out of the form. So we are now able to define and describe progressive, proportional, and regressive tax, define and describe marginal and average tax rates, and build the tax equation. Thank you.